All right, so we had our first official earnings week. Last week, bank earnings came out, but this week we had a lot of companies released. Nothing too major, but we also had the tech outage, which was probably the biggest piece of news from this past week. CrowdStrike sold off a lot on the news because they're the ones that messed things up. Although a lot of other big tech companies were down quite a bit. Some of them in relation to that, other ones not in relation to that. And I think the big take-home point from this week is it's looking like we're seeing a rotation out of large cap, typically tech names, and into the smaller and the mid caps or the value type names. And the reason for that is quite simple. The value names, or the smaller and the mid cap names, especially the better ones, there's not oodles of them, but there's quite a few of them that are undervalued, and a lot of these large cap names are overvalued. Some of them are egregiously overvalued. So I think that that's what we're going to see going forward. Now, that doesn't mean that the large cap names aren't going to continue to go up over the rest of the year. They're just probably not going to go up as much as they did over the first half of the year. And the other thing that's going to have to be kept in mind going forward is we have about a 90% chance that we're going to get a rate cut in September. And a lot of people hear that and think that's extremely bullish for stocks. But you also have to keep in mind that if you look back at history, after rate cuts, the majority of the time, stocks actually go down. But there's an important caveat there that most of the time, the Fed lowers rates in response to some crisis, i.e. 2008, i.e. the tech bubble, et cetera, et cetera. We don't have anything like that right now, but nobody knows that we couldn't have something in the next 6 months or a year. Like, nobody knows. And there's a lot of areas of the market that are clearly overvalued right now. So we could easily see a 10 or a 20% pullback. And we could see that without anything major breaking, without a major recession, without a tech bubble or a real estate bubble. Like, we could easily see that. So you got to keep that in mind. Do I think that's going to happen? No, I don't think that's going to happen for many reasons. And honestly, it would probably take 15 or 20 minutes to explain it all, so I'm not going to get into it. But I think the main reason is that you have to look at the fact that, number one, the next crisis is almost always different than the last crisis. So the people that think that, there's going to be a housing crash or a tech bubble, and it's like, look back at history. The crashes that have been unexpected to the vast majority of people up until right before they happened or very close to that. So that's something to keep in mind. I think that we're still going to close the year up. I think that it's just not going to be as bullish as the first half of the year. That's my prediction. And I think we very easily could see, in fact, it's overwhelmingly likely that we see a 5 or a 10% pullback at some point. Now, when it's going to happen, nobody knows. How deep it's going to happen, nobody knows. I think that it probably will be over the next few months or so. And then post-election, we probably see a bit of a bump, depending on, I think that, again, that there's a million things that could happen. Biden could drop out, or who knows, right? Look at what happened over the last couple of weeks. Like, nobody knows what can happen. There can be things that come completely out of left field. But there could be things that come completely out of left field that are bullish as well. So nobody can predict with 100% accuracy or even 80 or 90% accuracy what's going to happen to stocks going forward. But if you look back at history, on years when you've had the first 6 months that are up, especially up more than 10% or so, overwhelmingly likely that the next half of the year closes up as well, or is up as well. So I think that we close the year modestly up from here, but I also think that there's going to be that rotation. I think that the smaller caps, the mid caps, the value names probably will be the ones that will outperform over the next half of the year. So keep that in mind. The other big thing from this week, Bitcoin was up very nicely. It's up around 67,000 US at the time I'm making this video. And I think that it's only a matter of if, not when, we see a new all-time high. That resistance right around 64,000 roughly is going to be, it probably will be hard to break through. But when you look back at history, when Bitcoin breaks through those areas of resistance, it can break through and go up another $10,000 or $20,000 in a matter of a week. So keep that in mind, because I think we could have a month or two period where Bitcoin goes up like 50%, and I think that probably happens within the next 6 months, give or take. So keep that in mind. But I think that we easily could be up 50, 100% over the next 6 months to a year. As far as earnings go, this was the big news from the week, so let's get right into earnings news here. BlackRock, they released good earnings. They were up nicely on the week. I definitely would pick up BlackRock if you got it at a good price, although it would have to come down quite a bit from here. Goldman Sachs, a company I probably never would own because I think there's just better options, but I do watch it because it's a good barometer on how a certain area of the economy is doing. They did beat earnings and revenue. They were up modestly on the week. Bank of America, again, another one I watch just because I think that JP Morgan's probably the big bank. If you're going to own one, that's the one to buy. They released good earnings. They were up nicely on the week, although they did sell off post-earnings. But again, I think that's just with the market. And you've seen that with a lot of companies this week, that they released decent earnings, but they sold off because the market sold off. I think that's why you've seen a lot of these companies sell off, even though they released decent earnings. Morgan Stanley, I think, could be an example of that. They did beat earnings. They were down on the week. I think that Goldman Sachs probably is a little bit better than them, but I think neither one is good enough to own, at least in my opinion. United Health released very good earnings. They were up very nicely on the week. I would buy them if you could get them for a fair price, but that probably is in like the mid 400s. They're in the mid 500s right now. Very good company, but again, you look at their PE, 33, almost 34. That's way above the 5-year average of about 23. If I could get them for 23, 24, 25, I would buy it. But until it's around then, I would lay off. But I do think it's a very solid company. State Street, they released solid earnings. They did beat earnings and revenue, although I believe they're actually down a little bit on the week. No, they're actually up nicely. Sorry, I got them confused. Johnson & Johnson. Pharmaceutical companies are one of the few sectors that I would never buy. Another one I will get into later in the video. There's another example of this, because pharmaceutical companies are extremely hard to predict. And I think that you need to be basically you need to be an insider, or you need to be an expert, not only an expert but an expert on the industry, to be able to comfortably buy a pharmaceutical company, because they're so unpredictable, it's not even funny. And I think that there's better opportunities. ASML is a company that I definitely would be buying if you could get it for a fair price. It released pretty shaky earnings. It did sell off quite significantly on that news and on the large cap sell-off. Also, you've seen a pretty big sell-off in the semiconductor names, they obviously being in that industry. They're still way too expensive. I think they'd have to come down probably another 10 or 20% before I would pull the trigger. But if they were a fair value, I would absolutely, positively, 100% be buying them, because I think they're a really solid company. PLD, I've owned it in the past. I probably wouldn't buy it, at least where they're at right now. I think they're a decent real estate investment trust. I do think there's better options. They're one of the biggest ones, which is why I do watch them. FFO was down, although they were up on the week, although it looks like they were up quite significantly on that news. So I think they probably got caught up in the larger market sell-off. The next one is Crown Castle. Again, they're in the data center area. I think there's better options, but a lot of people do like them, so that's why I watch them. They released actually solid earnings. They did beat revenue and FFO, so that's good. They were up on the week, but I think there's better options. And I've talked about that before. DFS, they've gotten into the payment processor area recently. I still think that their moat is questionable compared to the big three in that industry. So I have them on a watch list. If I could get them for a good price, I probably would pull the trigger. But I'm not quite sold yet, although they did release their earnings. So definitely worth having on a watch list nonetheless. Rexer, I think one of the better REITs. I've never bought because I'd like to get it a little bit cheaper. But FFO for Rexer, they beat it. They beat revenue as well, but they were down a little bit on the week. Although similar story to PLD here, it looks like they were up quite nicely on that news, but they sold off as the week went on. Steel Dynamics. I really like Steel Dynamics. I've owned them in the past. I haven't bought them for quite a while because I think they're overvalued where they're at right now. But if you could get them for a good price, definitely an example of a company you definitely would want to buy. They did beat earnings and revenue, although I think they sold off basically with the market because they didn't release anything super bearish, at least in my opinion. UAL, this is the other example of the industry I never would buy. I think there's basically three examples of that, at least off the top of my head. Maybe shipping I would add in there, possibly. In fact, I probably would. But the three, in my opinion, are automakers, i.e. Toyota, Tesla, etc., airlines, pharmaceutical companies, and probably shipping companies. Those are the examples of industries that I almost certainly would never buy a company in because they're too unpredictable, and I think that the volatility is just not worth it. And again, they beat earnings, but they missed revenue, although they were up on the week. I think that's because they raised guidance, and air travel is still doing pretty good. So that's something to keep in mind there. I think that probably fades off a little bit, but at least where things are at right now, air travel is still doing pretty good. Abbott Laboratories, again, another example of a company I've owned in the past. I possibly would buy them if the value was right, but I think they're just too expensive where they're at right now. They did beat earnings and revenue, so that's good if you own Abbott. Solid company, but I think they're just too expensive where they're at right now. D.R. Horton, again, they're one of the big home builders. There's about 4 or 5 of them that I think are all solid. I don't think D.R. Horton is my favorite, at least right now. I don't own any of them because I'm kind of waiting for a pullback because they all had a massive run up this year, and I think they're pretty much all near their 52-week highs. But I think it's a very solid company. They release very good earnings. If you could get them for a deal, I definitely would be buying, but I don't think that's where they're at right now. Domino's, another example of a very good company that I would be buying if you could get it for the right price. It did release pretty bad earnings, which caused it to be down on the week. If you could get it for like $370, $380, that's probably roughly where I would look to pick it up, and I definitely would be picking it up, especially if it went even lower than that. But until then, I kind of just have it on a watch list, but I do think it's a company that's definitely worth buying if you could get it for the right price. Cintas, again, one of the companies that's actually flown under the radar this year. They're up like 50% or something like that off the top of my head this year. They're definitely very overvalued. If you could get them for a good price, I probably would buy, but they're extremely overvalued where they're at right now. They did release good earnings. They beat revenue. They beat earnings. Netflix. This is another example of an industry I probably never would buy in, streaming, because I think it's just way too competitive. It's almost impossible to develop a moat. If you could get a company in the very early stages, possibly, but at that point, it's extremely risky to buy a company like that. Like imagine buying Netflix like 15 years ago, maybe 10 years ago, but like 15 years ago, like it was a shot in the dark. So that's why I wouldn't buy a company in this industry because, like I said, it's impossible to develop a moat. And that's why I think it's just not worth it. And I think they're just way too expensive as well, a company like this. They did beat earnings and revenue, although they were down on the week, but I think that was just largely due to the larger tech sell-off. American Express, another example of a very good company. I would look to get them cheaper than where they're at. They did release good earnings, although they did sell off, which is I think, kind of surprising. although a very good company. Again, another example of a company definitely have on a watch list. If you can get it for a good price, I definitely would be buying. And the last one here is BMI. This is Badger Meter. Way too expensive where it's at right now. It would have to come down probably like 30%. But if you could get it for that price, I definitely would be buying. Definitely have it on a watch list. Keep it on a watch list. If you can get it for a good price, I definitely would be buying. So anyway, that is earnings news from this past week. We got the big tech companies coming up over the next few weeks, which is going to be very interesting to see. Very interesting to see what's going to happen going forward. I'm really excited. So if you have any feedback, any comments, anything like that, I'd love to hear that. If not, please like, comment, subscribe, all that good stuff, and stay tuned for more.